Welcome everyone to Shey's Way Tax Tip Tuesday, every Tuesday here at 1 o'clock, where we try to share at least a couple tax tips that to help you out in your financial endeavors, and certainly always looking to run against the herd and against the conventional wisdom. Again, let me welcome everyone to this week's episode where we're going to talk about all things regarding the protection component of your overall plan, the investment component of your overall plan, and the tax component of your current planning for today, tomorrow, and generations to come. It's no more difficult, regardless of if it's a financial plan, retirement plan, estate plan, legacy plan. It's no more difficult than protection, investment, and taxes. Remember, we're always going to lay out the truth, the facts, and what we believe regarding running against the herd and the conventional wisdom of what society tells you you should be doing with your money. We'll press you a little bit on the conventional wisdom as we believe that that's wrong. And again, we go back to, and I keep reiterating this for two different reasons. One, I hear Chris talk a little bit about from time to time, he feels like sometimes every week we're talking about the same thing, and not to say that we're all slow learners, but hearing it over and over again certainly is not going to hurt. The world that we live in today, with the amount of information that is being plowed at us every second through all of our devices that we all use, hearing it tends to make people think that it's more difficult than that, and a confused mind does nothing. And as you've heard me say, I believe there's two ways of doing things. There's the mature simplicity way, and then there's the sophisticated confusion. And I run away from anything that is sophisticated, confusing. I try to live my life personally and professionally in mature simplicity. That's what we get to do every week here at the Money School. So without any additional time, and if I forget, I'm going to pick this book up and set it up on my desk here to hopefully not forget to share that. And how's everybody doing in the March Madness brackets? And I'll throw mine out there. I've got in my final four, I've got 3 out of the 4 left. I did not have Duke getting beat by Tennessee, but Tennessee shocked me. So if you want to throw in the chat how your brackets are doing or how you're feeling about them, feel free. And then the second thing that I want to try to track a little bit today is, what are you reading that is helping you in life? And I wrote it that way because it doesn't have to be financial all the time or tax all the time. There are books out there that are going to help you in all of the areas of your life. And so I left it at, what are you reading that is helping you in life? Feel free to put that into the chat. Purdue lost off the bat. Yeah, Andrea, that wrecked a whole bunch of brackets. Get to deal with the grouchy husband. Again, if I forget, I do want to share a book with you guys a little bit later in the meeting. Again, Amy's going to come on here in probably about 10-15 minutes, and we'll talk a little bit about rentals and the tips and tricks that you can use. So I'm going to share my screen, take you through a couple different things. I was running through the archives today and ran across some information that I thought we would share, just to kind of get you thinking a little bit about what the rich and the wealthy do that maybe you're missing the boat on. So let me hit share here and try to bring this back up and run through just a little bit of information, and then we'll get into some tips and tricks for rentals with Amy. All right, so hopefully you're looking at my PowerPoint screen that just says the rich and the wealthy do. Now, as I was running through the archives, I ran across some information and some notes. And, we always talk about, number one, pay yourself first. And I throw that out at a minimum of 10%. There's a couple different theories and thoughts along that. But if you're not paying yourself first, then you're sending money somewhere other than your bank account, and whether it be your infinite banking concept or your savings accounts, your emergency funds, wherever. But we all have to work for a living. And every day you're going out into the marketplace, paving your way, doing what you do, creating some type of wealth for you and your family, provision for you and your family. And whatever money you're making, just think of taking the first 10% and paying yourself with that. Personally, I add another 20% on top of that for savings, emergency fund, that little thing out there called taxes. That's my rule of thumb regarding the income and the money that I generate for my business and my family. Number two, your money must work for you. So wherever you're looking to put your money, whether it be alternative investments, whether it be real estate, whether it be your permanent life insurance policies, whether it be your self-directed IRAs, your retirement, your money must be working for you. Make sure that it is not sitting stagnant. And number 2 and 3, 2 kind of rolls right into 3, and that is protect your wealth. And you hear us talk a lot about whatever you're doing, do something that you know, something that you like, and something that you understand. When you get outside of those lanes, danger soars waiting out there. So kind of put the guardrails up and stay inside of something that you know, like, and understand. For individuals out there, it's all over the place. Some may, be very, very fond about real estate. I can tell you that the commercial building that I personally own, I was very nervous back in, 2018, when I purchased the building. It hasn't paid off in an enormous way, but I was nervous because it was something that was a little bit outside of my comfort zone when I first did it. Again, if there's I forgot to say that, but if there's any Q&A, whatever, throw something into the chat box and I will get to it as rapidly as I possibly can. Number 4, be realistic. Going out and making 20, 30, 40% rates of your return, they don't happen every day. So be realistic. And this is kind of a shot across the bow to the people that push back looking for, show me the rate of return, show me the growth rate on this product, this investment, this life insurance policy, whatever it may be. I've always found it interesting, specifically when people talk about using life insurance as an investment, when I will always say life insurance is not an investment. It's actually insurance against your other investments not working out. Because the way that we design it, the way that we craft it, it is actually a hedge against your investments not working out. Don't be so energetic to ask about rates of returns inside of life insurance policies, things like that. There's nothing sexy about that. You're never going to get, 15, 20% inside of those types of strategies, but it is the protection component of your overall plan, which must be laid first. Number 5, solve other people's problems. A couple of weeks ago, I asked, most of the people on here are entrepreneurs, you're running your own business, whether it be an S Corp, an LLC, a C Corp, whatever you're doing, the money that you're going to make is a future-based revenue. And what I mean by that is, think of it this way. The past is the past and the present is where we're at today. So the checks that people are going to write, the revenue that you're going to generate, the value that you're going to bring people in the marketplace is going to occur in the future. You can't create that in the past. And right now, today, it's also not the future value or where those checks are going to be coming from. So think about when you go into the marketplace every day about solving other people's problems and helping other people get what they want to get out of life. Number 6, create a legacy. And I talked about this about 2 weeks ago regarding, what are you doing right now? Where are you thinking? Are you future-based thinking about leaving a legacy, whether it be for your children, whether it be for your grandchildren, whether it be if you're philanthropically inclined or charitably inclined, what type of legacy are you looking to leave when you're no longer here? And most of the time, that list stopped there. And the more I thought about it, I added 7, which fits right into this show, which is, what else do the rich and the wealthy do? They understand taxes, or they have someone that is helping them tremendously with the tax strategies and the tax planning that they are using in their overall financial plan. So again, those are the 7 areas that I believe that the rich and wealthy do that most do not. The interesting thing about when I went through this and I stumbled across the archives here at the Money School, obviously we talk a lot about using the component of be your own bank, the infinite banking concept, using permanent life insurance, specifically a whole life insurance policy that is put out there by a mutual company that pays a dividend. And when I look back over all of these, every one of these can fit into that specific strategy. I'm going to leave that hanging there. And if you have questions, let's just try to get together one-on-one, pick up the phone, call me. We can talk a little bit about it. But all 7 of those can be related on some level back to that one strategy that we all talk about, and that's using permanent life insurance. So I'm going to leave that with there. And I've got maybe 1 or 2 other screens that I want to talk about. And then Amy's going to come on and we're going to talk a little bit about rentals in that area. Let's talk about effective tax planning, which can accomplish much more than just saving income, taxes for your current years and your future years. If done properly, effective tax planning can maximize the amount of funds that you will have available for retirement, to reduce the cost of financing your children's education, to reduce eventual estate taxes that will occur if you grow a net worth over what the government allows. And it will assist you in managing your cash flow to help you meet your financial objectives. We'll talk a little bit about general tax tips here in a little bit. But right now, let's Amy, if you're on, if you want to come aboard. You guys have seen she's a repeat offender for some reason. She keeps accepting my invitations to come on the show, and she does a great job when she's here. Amy, I can't see you, but I'm assuming you're here.
I am here, but I'm having issues with my video again.
Awesome. Amy is CPA, 25 plus years of experience with Better Accounting. I'm gonna say you're out of Salt Lake City, Utah, because that's the big city, and I always forget the little one. But Amy, enlighten us a little bit on rentals and your tips and tricks.
So hopefully, I tried to think of something that could be used for a person that's just barely buying one, or ones that already have 3 or 4 or more. I just want to touch a little bit on when you tell your accountant what is the date of service for that rental. So this can go a couple different ways, but if you plan it accordingly, you can take a little more expenses up front and not have to capitalize them as much. The first way is, you already purchased a existing rental from someone, already has a renter in it. You're good to go there. Does that make sense? Date of service is the date that you purchased it then, because it's already being rented. Now, those ones that are empty and they need a little remodel done. So when is your date of service? So there is a couple different ways that you can look at this. So I always recommend that my clients go in, take an inventory of what needs to be done. So fix anything that has to do with the structure, like any structural issues. Does it need a roof? Does it need a complete bathroom remodel or a kitchen remodel? Get those done first, okay? Get the big major things that have to deal with structure done first, because they're going to be capitalized regardless of when it's put in place. Then, if you have to install or replace appliances, redo the painting, replace doorknobs, the little fixes that you always have to do for rentals, regardless of when you purchase them or when you re-rent them out. Get your approval and start advertising that rental as soon as you have your structural stuff in place. Then you can use the painting all those minor repairs as an expense instead. So you don't have to depreciate them over 27 and a half years. Now, if you put that date in place, that date of service after you finished all of those, it is bundled up and slammed in 27 and a half. So there's really no way of doing that unless you do a cost segregation on those. Now, cost segregation, I'm not sure if everybody's familiar with those, but that is where you have a third party come in and assess your property. They break out building, they break out land, and then they break it down into a 5, 7, and 15-year properties. And this is a great way if you're buying multiple properties, a great way to just kind of cash out just a little bit. Get a little bit more return on, more depreciation on that rental than you normally would, especially if you have other income coming in from other places that you could use this loss a little bit. Cost segregation works great. Make sure that you're putting that date of service in a timely fashion. Like find that little sweet spot that you can use expenses plus capital, use your structural. So you're working on that depreciation. One thing that a lot of people don't understand is when do you get to take those passive losses on your rentals? A lot of people don't realize that there is kind of a max. Once you reach that AGI of about 100,000 to about 150,000, it is actually allocated. It's rationed depending on your income. And then if you can't use it, then it's just pushed forward. So a way around that, be a real estate professional. Now, a lot of people can qualify for a real estate professional, but it can also be your spouse. So if your spouse has a smaller job, let's just say they're an admin, they work in an office, they work 20 hours a week, that type of thing, she can, or he can, depending on your situation at home, your spouse can help you manage that rental and become a real estate professional. There's a couple little requirements that you have to meet in order to be a real estate professional. So I'm going to just briefly run over those. If you have more questions, you can call me or, reach out and we can just schedule a time to talk about how to become that real estate professional, because one of you on a joint return has to be a real estate professional. And then those passive losses will be released and be able to use against your ordinary income. There's always pluses and minuses, but really being a real estate professional, you have to be in the real estate trade and working that for 750 hours per year. So technically, it's only basically 2 days a week that you have to allocate there. But if you also have a W-2 job, there's a little bit of finagling that you have to kind of judge there and prove that you're working them simultaneously. If you're single and looking for someone, go look for that real estate agent. Always, look for that, you can date anyone. So, hey, go ahead and, look for that real estate professional that's already involved in this type of stuff. And then there you have a great in right there to help release those passive losses. Does anybody have any questions on what I just threw at you or anything like that?
Amy, I had one that I just wanted to kind of clarify, and that is
Sure.
cost segging on residential property.
Mm-hmm.
I've heard a lot about cost segging, obviously on commercial, but is it apples to apples when you're thinking of it on residential?
Yes, it is. Yes, it is. So it's very similar to when you do a commercial building. They just go in. Because there's ways that we can reduce that depreciable rate down to a 5, 7, or 15 year. And right now that is bonused 100% as well. So that's a big, huge adjustment there for residential.
Okay. So this is a little bit I'm just going to be just forthright. And this is a little bit for me, just because I'm in this mode. And it wasn't that Amy and I kind of compared notes and said, hey, let's talk about this today. But I'm in the middle of completely gutting a residential property that I own. So Amy, talk me through just normal numbers. Let's just say that the property's worth 200 grand, but now I've gutted it and I'm going to put $30,000 worth of time, effort, new appliance, new paint, new this, new showers, just a total remodel. What's the best way for me to go about doing this?
When you're doing a remodel, I would ask for detailed invoices. If you're doing it through a contractor, make him break out every single item that he's working on and how much it costs. because I can take that because that's coming from a third party. I can pull that. I can put it in the different categories. You don't even have to get a third party for that because you're already inherited it, that type of thing. This is more of a remodel of an existing home. So that would work for me as well. So cost tagging can also be just itemizing those invoices and breaking them up into different categories. Is there any structural stuff that you're going to be doing, like roof or anything like that?
No structural, just all interior.
All interior. So we could probably just on average, I can probably write off probably 75% of those as an expense instead of. But the trick is to put that data service in correctly. So do your big things first, like your cabinetry, that type of things first. Save the painting, install the appliances a little later, get it out to rent, and then we can apply the expenses.
Awesome. Thank you for that. Again, if you have other questions, I'm kind of got my eyeball on the chat rather than the Q&A. So just throw them into the chat and we can cover them then. Aim, what else you got?
So with rentals, you also have to be actively involved in those rentals in order to take your losses. So, and that's really very simple. I mean, you can work with your property management person, talk with them, arrange, some of the repairs, go visit that home, just make sure that you're materially still involved instead of just having the third party just do it all for you. So still be materially involved in your rentals. And that's, it's very easy to do. So a lot of people, when you change renters, they're like, well, what is a repair and what is capital improvement? Similar to what you're doing, Brian. So you just kind of have to break it down. If it has to deal with structure, like the actual structure of the building, roofing, drywall, cabinetry, something that's attached to those walls, those are capitalized. That's the little things like the repairs that you have to do, the repainting, a lot of stuff that can be expense. So make sure that you're telling your accountant or bookkeeper or whoever is working on your books what exactly you're doing when you're doing your repairs. Because if we can expense it instead of capitalize it, you get a much better return on that. That's a really important question when it comes down to doing those repair maintenances and doing your big stuff with the buildings and stuff. But that is all. Is there any other questions? I kind of brushed over quite a bit of it. But we can dig down deep if you want to consult and just kind of look over what you have and go that direction as well. Because I know a lot of people have individual things that they're doing.
Yeah. Amy, let me throw a question that just came in from Mark, and that is, what is the process if your rental is owned by your self-directed IRA?
You can do the exact same thing in the self-directed IRA. Yes, you will show losses in your self-directed, but you're already doing that anyway. Because really your self-directed, that's really just for future stuff, but you can do the exact same thing. Regardless if it's a self-directed, it's still a rental. It's still a business. It's just that how it's being taxed. So you can use the same thing in your self-directed.
Okay. And I'm pretty sure I know the answer to this one, but I'm going to throw it out there because we talk a lot about, well, first of all, there's a tremendous amount of the population that come into the money school that we talk a lot about real estate investing and then holding those real estate properties in different LLCs or different entities. Amy, I'm just going to use the same question almost. What is the process if the rental is owned inside of a limited liability company?
That's actually the exact same. Honestly, it doesn't matter what the entity type is. A lot of people like to have a holding company hold all of their rentals and like have little DBAs underneath, or a single member LLCs underneath a holding company. Either direction, these tips can be used in any type of entity when you're dealing with real estate.
Okay. Real quick in the chat, I just dropped in the link to all of the recordings of these webinars that are on the sterlingwyatt.com website under podcasts. So any of the Tax Tip Tuesdays that we do are all there for your review at any point in time. I also just dropped in a link to a book that I'm going to share with you guys here in a little bit. Lastly, I wanted to mention, just to take some of Amy's airtime, I've talked a lot about if you're not working with a tax strategist or a tax planning company and you're only meeting with your CPA at the end of the year or this time of year, and it's more like a fire sale, trying to find some tax deductions or tax credits or whatnot. If you're not meeting with your CPA team every quarter is what I would say. This is, I'm being selfish today because I happen to be doing all of this stuff that Amy's talking about. I happen to be working with her and her company. I happen to have a meeting tomorrow with Rachel, which is probably Amy's right hand, and she absolutely runs everything that I do. And all of this stuff that she's talking about, I'm going, okay, I need to make sure that I'm running all of this by Rachel, because I'm painting and I ordered cabinets a week ago, and I'm redoing 2 different showers and putting floor in the entire rental property. And I've already shared a little bit that I inherited the property and my cost basis is all messed up and whatever may be. And then I'm also trying to move it into an LLC. So all of those things, I could wait till November or December and then try to get with them, try to unring the bell or fix the problems that I'm about to create. Or I could do what Amy's telling me to do, which is keep the receipts, get the third-party invoices, and share those with her team. Amy, if there's anything that I just mentioned there that sparked a couple other thoughts, feel free to let us know.
Oh, no, that's excellent, actually, because if we can help plan a little bit in advance, we can do the books accordingly. So there's not much cleanup that we have to do. So that your bill is not huge in December, November, December, trying to cram everything in. I love talking to my clients every 3 months, 2 to 3 months, depending on what's happening in your lives, even if it's just a check-in saying, hey, I'm doing good. I may have a couple of questions. Please don't hesitate to reach out, because I would rather plan now than scramble at the end trying to get you those tax strategies that you need to use for the year. I have one other tax strategy. Do you mind if I hop in with this one as well?
Not at all. Let us have it.
Okay. So those people that are getting close to retirement, they have 5 or 6 properties. They're not sitting where they want to be, honestly. And so one way you can do that is develop a management company. So set up a separate entity. I would recommend an S Corp, just because then you can kind of issue yourself a W-2 if you need that little extra boost. And then you manage your rentals and make them pay a management fee to that S Corp, that management company. This is the way you can still use tax strategies, especially if you are working a W-2 job and you want to pay your children. You want to use all of the other tax strategies, and that it's not working with the way you have your LLC set up. This is a way that you can still bring in a lot of tax strategies with your rentals. And this management company will not probably earn a lot of money. It will probably break even because you're doing all the tax strategies that you can. But it's an easy way to pull money from your rentals without showing, big, huge draws or something like that. Or if you have a partner in that, you can use the K1 a little differently also if you have a partnership with a K1. So I have lots of different directions we can go based on individuals and stuff like that we can work on together. So please give me a call. It doesn't have to be now. It can be in June or July. So please keep me in mind, when you're thinking about things. If you just want to do consulting, I would gladly do that too. I don't have to do taxes and I don't have to do your accounting, but I just like to help people get to retirement, save money, that type of thing.
Amy, thank you for that. Andy had a question, and I actually messaged him and just said, hey, let's connect one-on-one, but I'm actually going to put it out there. And if there's other people out there that want to throw their 2 cents in there, that's fine. And if not, that's fine. But here was the question. Andy said, for the purposes of asset protection, is there some kind of nifty way to release liability from the rental by leasing from the holding company to the LLC? What happens when your holding company gets sued by the tenant? Amy, I'm going to give you first shot. Do you have anything there? And if not, no big deal.
That is not something I've actually come across.
Okay. So, and Andy, you may just be a little bit more sophisticated, than I am here. I'm just going to give you my Blink, which is what I'd call my knee-jerk reaction. If you've never read the book Blink, very good book, but that's where it's from. But again, it's for the purpose of asset protection. Is there a nifty way to basically release liability on a rental by leasing it from the holding company to an LLC? And then what happens if the tenant sues the holding company? To me, when I read the question, and this isn't a shot at you, Andy, that's why I said, hey, reach out to me personally. It seemed sophisticated, confusing to me, where you've got a holding company and then you've got an LLC, and then is the LLC inside the holding company, and then the tenant sues the holding company. I'm going, all right, I'm looking for my Advil bottle already. So my first thing is are you trying to create more layers than are needed? Why not just put the rental company and leave it in an LLC and not have anything else inside the LLC? And then if the tenant sues the LLC, there's really no revenue there or income there. Maybe you're offsetting income and expenses, and there's really just nothing there, and it's holding a piece of real estate. That's my knee-jerk reaction. I don't know if that helps you at all.
When you have a holding company, you will also have single member LLCs down below. So the holding company will not be liable. So if one rental gets sued, it will go to the single member LLC's insurance. So they can't come after the whole holdings. It will be stuck in that single member LLC that's being managed by the holding company. So the insurance should just stay with the single member LLC and not be able to go after the holding company itself. It's just the disregarded entity that you are holding that rental for.
Yeah, that's good.
So that's what I kind of picture when but I am not an insurance person by any means, but that's how I picture it. That's why we set up those single member LLCs to protect the holding company and all the other rentals from being sued and taken if that does happen.
Yeah. Andy, let's try to go one-on-one on that.
Yeah.
Another question here from Andrea. I know what my answer is, but I'm going to let Amy have it. If you don't have rental properties currently, but would like to in the future, when should you start working with a CPA?
When you have a thought that you're ready to buy that, if not sooner.
Yeah.
So if you're ready to purchase, you go find a CPA that will fit your needs, honestly, because if you start from the very beginning, get everything set up properly, the CPA should be able to guide you in a way that so you don't have to backtrack, honestly.
Yeah. My answer was going to be yesterday, by the way, Andrea. I was just going to say yesterday. Let me rattle off. I just want to, at the beginning, I mentioned to you, it's the 21st of March. And, if you haven't filed your personal returns or whatnot, I was just going to run through just a couple general tax tips. Again, I said, if you haven't, or if you're getting ready to go meet with your CPA, just different things. And that would be number one, file on time. So if you're behind the gun right now, which probably you're feeling if you haven't already had a few meetings, but file on time. If you don't file federal taxes or file an extension by April 18th, then you may have some fines, you may have some different expenses that the IRS is going to levy against you. And then I'm going to mention this next piece because it always confused me and it confuses a lot of my clients. And that is the difference between a tax deduction and a tax credit. Your tax deduction reduces the total income your taxes are based on. So for example, if you've got a $50,000 taxable income minus a $2,000 tax deduction, then you've got $48,000 worth of new taxable income. Vice versa, to a tax credit reduces your total income tax that you owe. So for example, if you owe $10,000 in federal income tax and you discover a $2,000 tax credit, or your CPA identifies a $2,000 tax credit, now instead of owing 10 grand, now you get dollar for dollar and you owe $8,000 as your new total owed. So number two, and I always hedge saying these things, but increase retirement account contributions to reduce taxable income. And as you know, I'm not a huge fan of traditional 401k plans or SEP or simple IRAs, unless you're going to start moving that money over to the Roth side. But by increasing your retirement account contributions, you can reduce your taxable income. There's a total of 6 of these, just so you know. I'm on 3. Add to your 529 college saving plans. So if you have children out there, grandchildren that you're funding 529 plans to, they offer potential tax savings on multiple different ways. I'm not going to get into all of the different ones, but you can add to 529 college saving plans. Had a client just last week on Thursday that I met with that brought this one up, and I said, absolutely, max it completely out. Contribute to your HSA, your health saving accounts. Make sure you're contributing at the maximum level to your HSA accounts. That's not even a sometimes thing. I think that's an always thing. That one's easy. Fine tune your paycheck withholdings. If you're not looking at what your withholdings are, the average tax refund in 2022 was about $3,000, an increase of about 7% over the previous year, which is about $250 a month. So if you're withholding too much and you're letting the government hold that money, get with your HR department or your bookkeeping department and look at your withholdings. And then lastly, again, take all of the tax credits and the deductions that you're eligible for. Both of those have a reduction in what you're doing. Amy, does that spark anything on your end?
The good thing about HSAs, I love that. Max it out as much as possible. If you don't end up using that, you can roll that over into a traditional IRA and then roll it into a Roth. So don't let HSA just say, oh, it's just for medical. When it reaches a certain point that you'll never reach with that medical advice, you can roll it over because it gives you the same benefits as a traditional IRA on your tax return. So you can roll and use it to your advantage in the long run. So don't hesitate to max that out and use it as a savings account for yourself.
Lastly, I'm going to share this book with you guys, and it jumped off the bookshelf at me today, and I went, oh, you know what? I haven't mentioned this, so I'm going to remove my background here, so actually I can just share the book with you. And I posted this into the chat a little bit ago, but I've had a number of meetings with people that imagine that are looking at using permanent life insurance as part of their overall portfolio allocation. That is the direction that I use in my practice. 2 things. 1, I've recommended everyone that's ever been on this show, and for the better part of the last 5 years of my practice, I've recommended that if you have not read the book Power of Zero by David McKnight, you're really missing the boat. So that's 1. Something that McKnight states in his book is that for you to be able to get to a 0% tax bracket in retirement, there's no way to get there if you're not using some type of permanent life insurance. I'm not going to tell you it has to be one specific type. I'm just saying that there's no way to get there if you're not using some type of permanent protection. This is a book. It's called Money, Wealth, and Life Insurance. And it's by a guy by the name of Jake Thompson. I put the link, the Amazon link, in the chat. But I will tell you this. I have 50 copies of this sitting on my bookshelf. So if anyone wants to email me, I will send you a copy of the book. I don't know where you live or whatever the shipping is, but I'll probably just ship the thing to you. It's a whopping, hold tight, 61 pages long. I read it in about 20 minutes because I've been doing what I do for 25 years. I didn't write the book. I never even heard of the book till about 1.5 years ago. I was working with a dentist and he mentioned the book to me and I read it. Obviously, it's 61 pages long. It's not going to take you much, but it is a phenomenally well-written description of how to use permanent life insurance inside your overall portfolio. Sandy says she's reading it now. I've met with Sandy, but I don't think I ever recommended this book, but this is the book. And I'll just share a little bit on the back of it. It says America's elite have been using cash value life insurance to stockpile wealth for centuries. Used correctly, it is better described as a personal bank on steroids and a financial bunker for tough times. To be clear, this book is not about the typical garbage peddling by most insurance agents, rather an alternative to the risky investment strategies taught by Wall Street. So again, I don't know Jake, and I'm certainly not getting any royalties. Amy, your video's working.
I know. I just decided to click on it and see if it would work, and it does. So I thought, well, at least I'll say hi.
So again, I recommend the book. Matt has a question here. Let me read it. Is there a special way to roll the HSA to the 401k? First, I've heard of doing that. Let me clarify what Amy said, because I think it's going to answer the question. She said that you can move your HSA balances over to an IRA. You didn't say move to a 401k plan.
But sometimes you can move your IRA. So once you do that rollover, you can sometimes roll an IRA into a 401k, depending on the type of retirement plan that you have.
Yeah.
So you can't, so it has to be an IRA first, and then you can see what your financial institution will help you figure out that direction.
Yeah, Matt, I think no matter what you're looking at doing there, I use the analogy bus stop. I think you got two bus stops no matter which way you want to go.
I think so too.
You got an HSA, an IRA, and a 401k plan. You got two stops on that road, no matter what.
Yep.
Okay. And then Amy's right. Depending on what your plan document allows you or doesn't allow you to do inside the 401k plan. All right. Well, let me just say, Amy, thank you again for your time. Thanks for sharing all of your wisdom in today and bringing some great strategies to the rental space. Lastly, if you're looking for additional information or just want to schedule one-on-one to chat, you can access Amy through my website at sterlingwyatt.com. You have access to my calendar on that. We do a lot of joint meetings. I'm certainly not the expert when it comes to all of the finer details of the tax code. Today's webinar will be recorded, edited, and then put up here in the next couple of days. Again, appreciate everyone taking some time on a Tuesday afternoon. And again, if you're interested in the Jake Thompson book, reach out to me. Happy to ship you a copy of that. Anything else, have a great week. And hopefully your Sweet 16 becomes sweeter. And we'll see you guys next Tuesday. Take care.